So yeah, this one's going to be speed of profits. So this is really kind of delving into the idea of if we choose different profit targets, how long do we wind up having to stay into trades? And so, right, how much are we giving up in terms of time versus money? Right, this is sort of a constant trade-off in our approach, and this is just getting some numbers around it.
Cool.
I'm looking at it. So, right. Our general approach to retail option trading is that we want to sell premium and then manage winners. That's sort of our most bread and butter technique around here. And then this raises the question about how patient do you want to be on your winners, right? Where do you want to set that line? And I think for a long time, for a lot of years, we just set it 50% on every trade, no matter what, and walked away from it. And then we got into zeros, so like a little, almost 2 years ago now. And we discovered that on zeros, 50% was too high of a profit target. It was not nearly as effective to do a 50% profit target there as it was to do something more like 25%. And so this got me to thinking sort of, we've been taking 50% as sort of just given for so long. Maybe we should see what happens if we mix that up a bit, even in looking at 45 DT trades. So let's get into it. How long have short premium trades needed to stay in positions in order to reach different profit targets?
Yep.
Cool.
Do it.
And because I wanted to do a variety of deltas and a variety of profit targets, we're only doing one underlying today. It's all going to be SPY options. It's all 45 DT strangles. We're going to do a sort of a look at a bunch of different distances from the money and a bunch of different profit targets, and then we're going to look at sort of at a couple of statistics about them. We're going to look at how many of them actually reach their profit target, and then of those that reached their profit target. So this is not looking at all the ones that didn't. Just what was the average amount of profit collected, right? Which is very close to what was the average credit received times the profit target, and then what was the more interesting fact for me is what was the average number of business days that you had to stay in the position before management.
Okay.
Right. So if we were getting out at 21 day DTE, that's like about 20 business days later. If we're getting out less than that, that means that we were managing earlier. If we're taking longer than that, means we were sort of staying in past that 21 DTE line. And then lastly, I just wanted to pull out there's some number of trades that never reach their profit target, but still wind up being winners at expiration. And I wanted to just see how frequent that is and how that plays into how far from the money and what your profit target was. So that'll be the last statistic we look at. Oh yeah, so we can get into it now. Let's look at some numbers. Yeah. So when we're trading real close to the money, these 40 delta strangles, we see that the 50% profit target, if you do a 25% profit target, you manage most trades, right? 84% of them reach it. And of those that don't, there's only a 6%, right? Of those that don't, right, 10% are just losers. And then 6% wind up being in that winner, but didn't reach 25% profit target winner, right? So that's sort of explaining how those work out. Right. And the average managed profit scales exactly like you would expect. But the interesting part lies in the sort of the number of days where at 50% profit target, it wound up being very similar to getting out of 21 DTE as far as like when you actually wound up leaving it. That was around when profitable trades managed to reach that. If you were looking for 75% profit target, you were staying in significantly longer, right? You were in there for essentially another like almost 2 weeks, right? Week and a half.
And yeah, and your profit didn't go up that substantially either.
Right. Like and in fact, right, you're not managing that many of those trades. Only 35% of the trades reach 75% top target. In fact, much of the profitability there came from just the 39% of trades that
were somewhere in the middle, that were like 50% or 60% at expiration. Yeah.
Yeah. So I think that this slide to me makes it very appealing to use sort of a lower profit target when trading close to the money. And we'll see that sort of play out as we go forward. That I think the main takeaway for today is an idea that you can be a little bit more flexible in your profit target with the idea of when you're trading close to the money, take your profits a little bit faster. And if you're trading further out of the money, you can be a little bit more patient. So let's go forward and see how that plays out as we look at the other strangles. So yeah, 30 deltas, right? So in here we're sort of our core position, put them on all the time kind of trades. And here we see that 25% profit target again has this is probably too aggressive. Right, you're managing almost all of them and it's very quickly. So if you're willing to just put on new trades all the time, you can do it. But you're really cutting into your profits a lot, and you're essentially all of the losers are getting all of the anything that might be a winner ever is getting managed. Right, only 5% of trades are managing to come out in that middle space. And here, right, here's 50%. And I think this sort of fits with why we wound up with 50% as a profit target, is because we were also using 20 and 30 delta strangles as our baseline when we came up with those numbers years ago. And here, I think it's pretty, here, I think the 50% profit target one is sort of the most appealing row of this column, of this slide. Right, you're in there for less than only a couple of weeks, and you might make good profits. As we move further out, you see that it becomes more extreme, and those 25% profit targets, those really aggressive managements, become sort of, I think, too aggressive. But conversely, the 75% profit target stops looking so bad, right? Here in the 20 delta strangles, it's appealing. I still think here I'd prefer the 50% profit target here, but the 75% one also has a reasonable stat line. If you're selling 20 delta strangles, you can be sort of in that range is okay. And then when we move out to the 16 delta strangle, we'll see that like 50% profit target is probably too low actually for a 16 delta strangle. As we go, let's take a look. One more. Yeah, here we are. Right, because here we're winding up with this thing again where the 26 and 22 days are flipped. That is just a typo.
Okay, cool. Yeah.
I apologize.
Should be 10, 22, 26 is what you mean.
Yeah, got it. Yeah.
Right, here you see that, right, like looking for 75% profits out of your 16 delta strangles doesn't actually make them take that much longer. If those that reach 50% profits very frequently also reach 75% profit not that much later. And right, that's partially because the credits are so small, right, that there's not that much distance to move when you've got a good position like that. But I think that this is sort of my like thing that someone actually might change about their mechanics going forwards here, having looked at this piece, is that if you're trading real far out of the money, right, if you're in the sort of 16, 10 delta strangle kind of range, if you like those far out of the money trades, which is a valid thing to like, you maybe want to be a little bit more patient with your profits. Let them come in a little bit further before you take them off. Don't wait till expiration all the time. We know that really blows up your justified risk and such. But you can be a little bit more patient. Wait till they get past 50%, right? If it's past the 21-day line, maybe you want to manage it anyway. But if you're still in the first half of the trade and you've taken in a good profit, you maybe can stay in it a little bit longer and see if it ripens a bit more for you.
Yeah, and it makes sense.
And Jacob, you think that's because of smaller credit you receive on entry? I mean, is that really what
I think that's the primary thing going on, right? It's smaller credit, and it's the fact that the position was sort of safer to begin with by bringing out of the money, so you can be a little bit more patient with letting it come in for you.
Makes sense.
Right, and of course, right, this is just a testing of like some fixed points, so it doesn't say where the like real optimal profit targets would be, right? Maybe it's like 63% would be the best performing one. I don't know. But this is to give people, at home sort of their ballpark for how they want to adjust into more of a qualitative sense of the further out of the money you are, be a little bit more patient with the profits. If you're trading real close to the money, be real aggressive, take those off quickly, put fresh ones on. Seems like the real winning strategy from this piece.
Totally agree. Good job.
Yeah, we can go takeaways, but I think I've more or less.
Yep.
More aggressively capturing winners, more reliably trades profitable, but lower average profits. Very straightforward and intuitive. Because of their smaller initial credits, further out of the money positions were better able to reach larger portions of their maximum profit. So while we often default to 50% profit targets, being willing to lower this further out of the money or closer to the money and raise it further out of the money may give you sort of more consistent, nicer results over long term. So I think that's a nice little, just little, everyone can refine their management mechanics every week around here.